while being slightly fast-paced. The stock price of Plug Power Inc. Plug is currently $3.90, reflecting a substantial plus 14.04% intraday movement as of the market close on October 13, 2025, which represents a gain of $0.48 from the prior close. This remarkable surge, however, is not the full story. The real twist lies in the highly unusual institutional tug-of-war that has defined the stock's recent dramatic volatility, suggesting that while the retail investor narrative is one of pure momentum and green energy excitement, the smart money is far more conflicted, creating a massive expectation versus reality disconnect. The immediate expectation surrounding Plug Power stock is a continuation of the parabolic rally it has experienced over the past month. This is a classic momentum trade, fueled by whispers that hydrogen is the perfect complement to the soaring power demands of the artificial intelligence sector, a narrative that has taken hold in the absence of consistent profitability. The reality, however, is far more precarious. This move is less about a fundamental, sustainable business inflection and more about a brutal technical squeeze. In the last reported quarter, institutions were net sellers, reducing their average portfolio allocation to the stock by over 20%, even as the overall number of institutional holders remains high at over 600. The major volatility you're seeing, the daily double-digit swings, is a signature of a short squeeze and high-frequency trading activity, where short interest, which recently hovered near its all-time high of over 30% of the float, is being challenged by a sudden rush of bullish sentiment and analyst upgrades. The expectation is a simple breakout. The reality is a high-stakes, hyper-volatile gamble where the short sellers are battling the retail momentum crowd, all against a backdrop of deeply concerning underlying financials. This high-octane trading is a microcosm of the hydrogen sector's promise and peril. The market's expectation, driven by the clean energy transition, is that Plug Power, as a vertically integrated leader in green hydrogen, is on the cusp of a major breakout. They see a company that not only produces the hydrogen, but also builds the fuel cells, GenDrive and GenSure, and the necessary infrastructure, giving it a powerful, defensible moat in a nascent industry. This expectation has been bolstered by significant commercial wins, such as the expanded, multi-year agreement with a major industrial client that includes a ramp-up to 15 tons per day of green hydrogen supply, a tangible sign of operational execution. Moreover, the announcement of a CEO transition, with the longtime leader stepping down for a new executive, is often interpreted by investors as a strategic refresh, a move to pivot from a growth-at-any-cost mentality to one focused on financial discipline and profitability. The recent $370 million warrant inducement agreement, while immediately providing a much-needed cash infusion, is the bitter pill that challenges this rosy expectation. The reality is that this cash raise came with the massive cost of shareholder dilution through new warrants, a stark reminder of the company's persistent negative free cash flow, a continuous cash burn that requires these repeated trips to the equity market. The market cheers the cash, but the astute investor recognizes the long-term price paid in shareholder value. Zooming in on the recent price action, the stock's massive surge from below $1 just a few months ago to its current price has an RSI well into the overbought territory, a technical indicator screaming a potential reaction downwards. However, technical analysis in Plug Power stock is often overshadowed by macro catalysts. The recent bullish analyst upgrades, specifically one that took a price target from $3 to an aggressive $7, acted like rocket fuel, sparking the initial short covering rally. This is a classic tension between a contrarian take and the general market belief. The common belief is that the stock is highly speculative, but the contrarian take, supported by the H.C. Weingart upgrade, suggests that the accelerating cost of traditional power sources and massive government subsidies, like the DOE funding and the Clean Hydrogen Production Tax Credit Extension Act, have fundamentally de-risked the investment case. Yet, even as the stock was soaring, another firm, Clear Street, downgraded it to hold, citing valuation concerns after the spike, perfectly embodying the divided institutional view. Investors utilizing platforms like Interactive Brokers Trading Platform for its advanced analytics or Fidelity's research tools must confront this schism. Is the surge a technical anomaly or the start of a genuine policy-backed fundamental breakout? The high trading volumes on days of rising prices, a positive volume balance, show accumulating optimism among high-conviction buyers, which technically supports the current trend. But the extreme volatility, with the stock moving more than 5% in a single day over 100 times in the last year, demands a level of risk management far beyond what typical online investing or self-investing sites like Robinhood might imply with their simplified user interfaces. This isn't a slow burn, it's a flash fire, and you need to treat it such, understanding the technical forces at play. The core business of Plug Power is centered around electrolyzers for green hydrogen production, fuel cell systems for material handling like forklifts in warehouses, and stationary power. The historical performance is what truly anchors the current market expectation. For nearly 25 years, the company has grappled with consistent profitability, posting deeply negative gross margins and massive net losses, including a recent quarter where they lost nearly 10% of their current market capitalization in just 90 days. Their main challenge has been the cost of hydrogen itself, often purchasing it at volatile prices that destroy margins. This is the major point of friction between the optimistic expectation and the sobering reality. The company's long-term thesis is that its vertical integration, building its own hydrogen production plants in places like Georgia and Louisiana, will eventually allow it to control the cost of fuel, finally moving towards a positive gross margin rate by the end of 2025 and positive EBITDA margins by the end of 2026. This future-looking guidance is the expectation driving the stock now, but the reality of their track record makes it an execution gamble. The market is pricing in perfect execution on a multi-billion-dollar industrial build-out, which historically is a high-risk proposition. Investors, even those using intelligent portfolio strategies through services like Schwab Intelligent Portfolios, must weigh the company's vision against this historical financial drag and massive dilution risk. Looking ahead, the future outlook for Plug Power is a classic study in potential asymmetric upside balanced by existential risk. The primary catalysts are tied to government policy and macro energy demand. The AI boom, which requires massive continuous power, is creating a new unexpected demand narrative for hydrogen as a scalable, non-intermittent power source that can complement nuclear and renewables. Additionally, successful completion and full ramp-up of their green hydrogen plants are the single most important operational catalyst for achieving the coveted positive gross margins. The new CEO and management team now face the ultimate reality check. Can they execute on these industrial projects and manage the massive capital expenditure without further destructive dilution? The risk remains the company's precarious liquidity position and the continual reliance on equity raises, evidenced by the $1 billion at-the-market equity sales agreement. Another significant risk is the ongoing competitive pressure from alternative clean energy technologies, particularly in the battery and other fuel cell segments. The opportunity, however, is clear. If Plug Power can bridge the gap between their ambitious production targets and their persistent negative margins, leveraging their scale and vertical integration in a burgeoning government-backed hydrogen economy, the upside could be significant. The expectation is the stock will continue to ride the hydrogen wave to new highs. The reality is that this wave is currently built on a foundation of massive financial risk and a race against the clock to achieve self-sustaining profitability. For those of you tracking this volatile name on your Fidelity mobile app or analyzing its moves on the Interactive Brokers platform, it's crucial to remember that this isn't simply a technology play. It's an industrial build-out play with a high capex requirement and a long gestation period. The tension between the incredible technological promise of green hydrogen and the brutal financial reality of industrial-scale capital formation defines the investment thesis. It's the kind of high-risk, high-reward stock that demands meticulous attention not just to the chart, but to the balance sheet. Comment below how many shares of Plug Power you currently hold, or if you're waiting for a pullback to a key support level before considering an investment. The final takeaway is this. The market's enthusiasm for Plug Power's growth story, the expectation of a green energy giant, has momentarily overpowered the reality of its negative cash flow and dilution. The stock's dramatic recent run-up is a victory for momentum traders and short squeeze dynamics. But for the long-term investor, the ultimate verdict will be delivered not by the chart, but by the next few quarters of margin improvement and production ramp-up. We're watching a high-stakes turning point where the company must execute flawlessly to validate the price the market has assigned it.